I've been through 12 recessions. 12, and every single time, I came out ahead. Not because I was lucky. Not because I had some inside information. But because I understood something that most people still haven't figured out. That the clearest message I ever send isn't something I say. It's something I do. And right now, I've done something so loud, so deliberate, so impossible to misread. That if you know how to look at it, you already know everything you need to do before 2026 arrives. Most people are watching the news. They're reading headlines about tariffs and interest rates and GDP forecasts. And while they're doing that, something else entirely is happening right in front of them. I'm not saying that to alarm you. I'm saying it because I've watched this pattern repeat my entire life. The people who get hurt most in a recession aren't the ones who ignored the warnings. They're the ones who are reading the wrong signals. So I want to do something a little different today. I'm not going to tell you what to think about the 2026 recession. I'm going to show you what I've already done, and what each of those moves actually means for someone in your position. There are 6 signals. Not 6 opinions. Not 6 predictions. 6 things I've done with real money, in the real world. That tell a very specific story about what I believe is coming, and what I think the right response is. Most of the advice out there tells you what to do. This is going to tell you why, by reading the actions of someone who has already done it. And by the end of this, you'll have a clear, concrete framework for translating each of those signals into something you can actually do starting today. But first, I want to start with the signal most people have already noticed, and almost universally gotten wrong. Warren Buffett hasn't said a word about the 2026 recession. He didn't have to. He said it with $334 billion in cash. That number isn't an accident. It isn't a coincidence. And it isn't what happens when a very old man runs out of ideas. Here's what most people don't realize about that number. Cash in the hands of most investors means hesitation. Cash in my hands means something very different. It means I'm waiting. I've spent my entire career saying that cash is uncomfortable to hold and comfortable to have. That's not a clever line. It's the description of a very deliberate psychological and financial position. For years now, Berkshire Hathaway has been selling, quietly, consistently, quarter after quarter, reducing equity positions and letting the cash accumulate. When people ask why, the explanation offered most often is that we simply couldn't find anything worth buying at current prices. That's partially true. But it misses something much larger. The cash isn't a symptom of not finding opportunity. The cash is the strategy. And here's why that matters for you specifically. Cash gives you the ability to act when everyone else is being forced to react. In 2008, when institutions were selling anything they could touch just to stay solvent, I wasn't scrambling. I was choosing. Carefully. At prices that reflected other people's desperation, not the actual worth of what was being sold. That moment only comes once or twice in a generation. And the only people who can take advantage of it are the people who arrived prepared. Not the people who prepared after the headlines made it obvious. So before anything else, I want you to do one thing. Calculate your actual liquidity ratio today. Not a rough estimate. The exact number. What percentage of your net worth could you access in 24 hours? If that number is below 15 to 20%, you are carrying more risk than you know. Not because a crash is guaranteed tomorrow, but because your position determines whether a downturn becomes your crisis or your opportunity. The question isn't what to buy. The question is whether you'll even be able to buy when the moment comes. But here's where it gets complicated. Because some of you just heard that, and your first thought was, good. I'll do exactly what Buffett says. I'll be greedy when others are fearful. And I need to stop you right there. That phrase is probably the most repeated piece of advice I've ever given. And for most people who hear it, it is genuinely dangerous. Not because it's wrong, but because it has prerequisites that I never listed. And those prerequisites are the entire point. Let me tell you about someone I observed closely during 2008. Intelligent. Disciplined. No significant debt. A portfolio any financial advisor would have called solid. When the market started falling, they did exactly what they believed I would do. They leaned in. They bought. They told themselves they were being greedy while others were fearful. And they lost a significant portion of what they'd spent 15 years building. Now here's what they didn't know. In that same period, I wasn't buying ordinary shares on the open market. I was negotiating directly with Goldman Sachs, preferred stock, guaranteed 10% annual dividend, plus warrants to purchase common stock at a favorable price. Terms no individual investor could have accessed. Terms that only existed because Goldman needed capital badly enough to give them to me. Same market. Same moment. Completely different instruments. Completely different outcomes. The asymmetry wasn't visible from the outside. It looked like we were both following the same principle. We weren't. We were playing entirely different games on the same field. So before you tell yourself you're going to be greedy when others are fearful, ask yourself this honestly. If you bought aggressively into a recession tomorrow, and the market took 4 years to recover, not 4 months, 4 years, would you still be standing? Or would the pressure, financial and psychological, eventually force you to sell at the exact bottom? Because if the answer is anything other than a clear yes, that quote doesn't apply to you yet. There's something else you need to build first. And most people have never heard it described this way. Think about a castle. The walls can be thick. The gate can be reinforced. But if the moat is dry, none of that matters. The enemy just walks up to the door. I've spent my career looking for businesses with what I call an economic moat. A durable advantage that protects them from competitors, from downturns, from disruption. A moat is what separates a business that survives hard times from one that gets destroyed by them. But here's what most people never ask. What does your own financial life look like from the outside? If a recession walked up to it right now, is there a moat? Or is the path to your front door completely open? The personal moat has 3 layers. And the reason most people don't have them isn't laziness. It's that no one ever told them to build them. The first is an income moat. If every dollar you earn flows from a single source, one employer, one client, one contract, you have no moat at all. One decision, by one person, in one meeting and it's gone. The people I've watched come through recessions intact almost always had more than one stream of income. Or held a skill so specific and valuable that losing their position was essentially not an option for whoever employed them. Think carefully. How many hands does your income pass through before it reaches you? And how many of those hands could let go without any warning? But that's only the first layer. Because even people with multiple income streams have walked into recessions and gotten hurt. And when you look closely at why, it almost always comes down to the second layer, the one they never thought to measure. The expense moat. Think of it like this, your fixed costs are the floor of your life. The higher that floor sits relative to your income, the less room you have to move when something changes. When your rent, your loan payments, your minimum obligations consume 70 or 80% of what you earn every month. You're not living, you're performing. You're maintaining a structure that requires everything to keep going right. The people with the strongest expense moats, I know, live genuinely well below what they earn. Not because they're miserly, but because a low floor means freedom. When income drops 30%, they adjust. When prices rise, they absorb it. Their life doesn't collapse because conditions changed. However, even a low floor doesn't protect you if what you earn can be taken from you entirely. And that's where the third layer comes in. The skill moat. I'm talking about capabilities that compound in value as you develop them. Things that become harder to replace, not easier, as years pass. In a recession, generic skills are the first to go. Specific, deep, irreplaceable capabilities hold their value, or actually increase in value. Because the supply of people who have them doesn't shrink just because the economy does. So here's the question I want you to sit with. Which of your 3 moats is thinnest right now? Not which one sounds most interesting to work on. Which one is actually most exposed? Because a recession won't come for your strengths. It will find the gap. Now I want to talk about something that most financial advice gets exactly backwards. And getting it wrong might cost you more than any bad investment you've ever made. There's a belief, deeply embedded in how most people think about money, that success comes from decisive action. From seeing opportunities. From moving quickly. From doing something. I've been investing for more than 7 decades. And the single most important skill I've built isn't knowing when to act. It's knowing when to do absolutely nothing. There was an 18-month stretch during one of the most volatile periods I've ever seen where I didn't make a single major investment. Not because I wasn't paying attention, I was watching every day. Not because I couldn't find things to buy, there were options. But none of them met the standard I'd set before the volatility started. And I had made a decision, calmly, before the chaos arrived, not to lower that standard under pressure. Most people cannot do this. Think about what happens when you see a bear running toward you in the woods. Your brain doesn't say, "Let me evaluate this calmly." It says, "Move. Now." That response kept our ancestors alive for 100,000 years. But it will destroy a portfolio in under 10 minutes. Because the market is not a bear. The correct response to a falling market is almost never to run. There's a study from Fidelity that found the accounts with the best long-term performance came from 2 groups. People who had completely forgotten they had the account, and people who had passed away. Not because those investors were geniuses, but because they were never there to make a decision. Every choice they didn't make was a mistake they didn't commit. In a recession, every time you open an investment app while the market is red, your nervous system is loading a weapon that's pointed at your own future. So the discipline I'd encourage you to build before 2026 isn't a buy list or a sell trigger. It's simpler and harder than either of those. It's a written decision made today while you're calm, about exactly what conditions would cause you to change your position, and exactly what conditions you're going to ignore, no matter how loud the world gets. There's one number I watch more carefully than almost anything else. It doesn't make the nightly news. Most people have never heard of it. But it tells you, with more clarity than virtually any other single measure, whether the market is trading at sensible prices, or whether it has quietly detached itself from economic reality. The measure is simple. Take the total market value of every publicly traded company, divide it by the country's GDP. Think of it as asking, how much is the financial world claiming it's worth, compared to how much work the actual economy is doing? When that ratio sits below 75%, historically stocks are cheap. Around 100%, they're roughly fair. But when it climbs dramatically above that, as it did before the dot-com collapse in 2000, as it did before 2008, and as it has again right now, it means the price tags on publicly traded businesses have grown far faster than the businesses themselves. That gap always closes eventually. It has never not closed. I wrote about this measure in Fortune magazine in 2001, and I described it then as probably the best single measure of where valuations stand at any given moment. I haven't changed that view. Now, this number is not a countdown clock. Markets can stay elevated longer than logic says they should. But what it tells you is something specific and important. The risk you're accepting when you add to equity positions today is not a normal amount of risk. You're not paying for what these businesses are earning. You're paying for what the market is hoping they'll earn. And hope, in my experience, is not a reliable foundation. I don't use this number to time anything. Nobody does that reliably. I use it to calibrate how much I'm willing to put at risk in any given moment. When the number is high, I hold more in reserve. When it corrects, and it will correct, I'll be ready to move. The question I want to leave with you is this: are the prices you're paying today reflecting genuine value? Or are you paying what the crowd is paying because you're afraid of being the one who didn't show up? There's one more thing I want to address, and I'm going to be direct about it. Because it touches on advice that has my name attached to it, and I think it's doing real harm. What is it? It's this: I am famously skeptical of diversification. Charlie Munger and I have both said, more than once, that excessive diversification is a form of madness. That it guarantees mediocre results and reflects a failure to understand what you own. I believe every word of that. But if you are using my position on diversification as justification for concentrating your own portfolio, you may be making the most expensive mistake of your financial life. Here's why. When I talk about concentration making sense, I am speaking from a position where I have an internal research team that analyzes companies continuously. Where I've spent 7 decades developing frameworks for evaluating businesses that most investors will never have access to. Where Berkshire's balance sheet is large enough to absorb significant downside without it threatening a single operation we run. And where my investment horizon is longer than most institutions can even plan for. When Charlie said excessive diversification is madness, he was talking to people with the time, the tools, and the depth to do genuine fundamental analysis. Not people refreshing a brokerage app between meetings. For most individuals, and I've said this plainly in shareholder letters, the right investment isn't a concentrated portfolio of individual stocks. It's a low-cost index fund, held consistently, through downturns and recoveries alike. That approach is actually closer to the spirit of what I do than copying my specific positions. Because the goal was never to do what I do. The goal is to understand why I do it. And find the honest equivalent for your own knowledge, your own time, and your own risk tolerance. Chasing someone else's conviction without their preparation is not investing. It is speculation dressed in borrowed clothes. Now let me bring all of this together. 6 signals. And the only reason any of them matter is if you know what to actually do with them. Here's the thing. Most people hear a framework like this and feel motivated for about 48 hours. Then nothing changes. So I want to be very specific, and I want to be honest about why each step matters and what happens if you skip it. The first thing, your liquidity position. Not a rough estimate, the exact number. How many months of living expenses could you cover right now in accessible cash? If the answer is less than 6, That is your one and only financial priority before anything else. Not investment research. Not portfolio optimization. A 6-month buffer. Because you cannot think clearly when you're desperate, and you cannot act strategically when you're in survival mode. People who enter a recession without that buffer don't get to choose how they respond. They just react. But once that buffer is in place, your whole posture changes. You stop defending. You start looking. The second thing, your 3 moats. Assess them honestly: income, expense, skill, and identify which one is thinnest. Then pick one. Just one. Give it 30 days of focused attention. 1 month of real work on your most exposed layer is worth more than a year of reading about recessions and doing nothing. The third thing, and this one most people skip entirely because it feels unnecessary when things are calm. Write down your inaction rules before the volatility arrives. What would actually change your position? What would you refuse to let change it, no matter what? Write both down. Sign your name at the bottom if that's what it takes to hold yourself to it. Because when the market is falling and the headlines are screaming, you will not remember what you thought calmly. You will only act on what you decided in advance. And the fourth, look up the Buffett indicator yourself. Don't take my word for it. The number is publicly available. Look at where it sits today. Look at where it was before the 2 largest corrections in the last 30 years. Then ask yourself a simple question: are the prices I'm paying right now reflecting genuine value, or am I paying for collective optimism? I'm not nervous about what's coming. And I don't want you to be either. Nervous is for the people who didn't prepare. And preparation has never been complicated. It just requires honesty that most people find uncomfortable, and patience that most people mistake for inaction. The wealth gap that forms in recessions isn't created during the recession. It's created in the months before. In the quiet moments when someone decides to read the signals instead of react to the noise. When someone chooses to understand what an action means, rather than copy it blindly. When someone builds a moat, holds their cash, writes down their rules, and then waits, patiently, clearly, without panic, for the moment when preparation becomes advantage. I've watched enough history to know this with certainty. The people who came out ahead were almost never the ones with the most money going in. They were the ones who understood what the signals were actually saying. You can be that person. The signals are clear. The framework is here. The work is yours.